Welcome to our High Rock Private Client monthly video for April. I'm Scott Tomlinson, and with me on the call is Paul Tepsich, the founder and our managing partner and portfolio manager at High Rock. And also with us today is Diane Leckie. Diane's going to have some updates for you on the tax packages, so please stay tuned at the end. Let's talk a little bit about March, Paul. Lot less volatility than we saw at the beginning of the year. That meant for better stock markets, more correction to what we'd seen, upside correction, as there was short covering and probably a bit more technical in nature. Certainly, equity markets were better across the board. Global equity markets up by just around 2%, but that didn't help balanced portfolios much because the flip side of that were that bond markets were significantly lower, and certainly that's a function of what's coming from an interest rate scenario. Paul, any comment there?
Yeah, actually, and we don't have a chart on this, but you typically show the VIX, which is the volatility of the equity markets, but I'll tell you, the volatility of the government bond markets are way higher vis-a-vis the equity markets. So there has been a lot of damage done to the government bond markets. So it's kind of interesting that bond markets appear to be taking what the Fed says in rather seriously, yet the equity markets are taking it in stride.
Yeah, and I think you can see that here as we look at the year-to-date chart on prices, and of course that tells a whole story there in itself. But balanced portfolios in general are down significantly, and because on the year equity markets, other than the TSX, that is, are down, and so are the bonds, and that really is a difficult situation for those folks who have balanced portfolios, where balance is intended to have some offset. So stocks going down tend to be offset by bonds going up, but this isn't or hasn't been happening in the first quarter of 2022. Paul, any comments there? As you were saying, we're seeing bond markets taking the Fed seriously, and while we're talking about that, perhaps I'll just jump to the next slide. But certainly, what the Fed told us in March when they had their most recent meeting was that interest rates were going up, and probably significantly on the back of some of the inflation data. So please feel free to comment.
Yeah, well, I'll make two comments. Number one, just a clarification point that balanced portfolios in general, certainly in North America, have had a very rough go year to date, first quarter of 22. But I would clarify that High Rock balanced mandates have not had a horrible start to the year. We have been able to kind of tread water here, and we'll get into the reasons why shortly. With regards to the Fed's dot plots, I personally don't put a lot into this because I don't think the Fed is really ever right, but nonetheless, it does scare the market, and it is scaring the government bond market a whole bunch more than it is scaring the equity markets right now. My personal view is I think they're probably calling for 7 rate hikes across the course of 2022. I personally don't think we'll see more than 3 or 4. And I think that there's such a wealth effect built up in equities now from all the stimulus that has been put in place in the last 2 years of COVID that, quite frankly, the Fed nor the Bank of Canada or any sovereign government here in the Western democratic world could afford to see equity markets plunge 50%. So I think they're going to turn around. It's likely we're going to have a recession in about a year, but I think they'll turn around and cut rates and start quantitative easing again, and do so very quickly. It would be a shallow and narrow recession. That's my view.
Okay, Well, thanks for that. And I should clarify too, when I talk about, and I show the charts with the balanced index on there, that is a passive balanced mandate. And of course, at High Rock, we have a much more tactical balanced structure. So it does go to show how um, our tactical portfolio management adds considerable value in times like these when there is lots of volatility. And of course, when portfolios go up, that's everybody loves it, but nobody wants to see their portfolio go down by anything significant. And if we can contain the downside, that just means we can get back to a growth position that much more quickly. And that's why we have a more tactical approach to our balanced mandates. And speaking of that, of course, it's always about the long term, but we know that as we get more volatility and going forward, we're probably going to see balance mandates and passive balance mandates underperforming what we have come to expect in over the past 7 or 8 years. So I think what we have to do is start to think on a more forward-looking basis, and perhaps not be as focused on that passive kind of mandate, but get even more tactical as time progresses in order to keep our portfolio growth above this higher level of inflation that we're seeing right now. But as Paul said, if we do get a recession, it's likely going to contain that inflation that we've seen, but we'll have to wait and see how that unfolds. Global equity strategy remains to buy value. And as we look back at history, we see that current levels, while they've come off their highs, are still elevated. And as a result, we just don't have a whole lot of interest in putting new cash into the equity market at this stage. But as Paul said, we could see a material reduction in equity prices, and that would give us lots of potential for value. So we're going to be patient, and we'll find opportunities to put money to work when we get there. Paul, speaking of tactical strategies, I'll let you take the floor.
Our tactical model, we haven't really done a whole bunch in the portfolio across the month of March, say for one new position we initiated. And our MO in the tactical model right now, and I wrote a blog on this last month, I think, on owning molecule producers. So I think the world we're finding out now is in short supply of all kinds of molecules, and you can look at the periodic table, which we used as a picture, and take your pick. Well, our pick has been for quite a while been in oil and natural gas, the two fossil fuel forms of energy. They've been heavily underinvested over the last number of years. These companies have stared over the abyss since 2015. They have cut, for various reasons, they've cut expenses dramatically. And the old model was to continue to plow capex into the drill bit into the ground, drill for oil, and keep production growing, keep the stock moving higher. That was 5-6 years ago. That is long gone. These companies now are delevering dramatically and not increasing production and not worried about the growth of the stock, because that, as you can see by this chart in Baytex, which is obviously one we own, and we own probably $1.25 area average cost base, has been paying down debt dramatically and barely growing production at all. And I don't think any of these companies in North America, any of these E&Ps, are going to grow production no matter what happens. So these companies are going to be, over the medium longer term, I think they will just be dividend payers. They're going to be debt free and dividend payers, and probably even privatized, because of the lack of capital that is willing to go into fossil fuel energy risk. The next one chart we have here is something, a company that we initiated on. Most of our clients own bonds in Sherrod International. It is a Canadian company, but it has a 50% JV interest and operates a nickel and cobalt mine in Cuba. And if you're on the other side of the coin from fossil fuels, you're interested in renewables and sustainable energy, nickel and cobalt are critical battery metals that are required from everything from cell phones to laptops to obviously electric vehicles, being the biggest user of those two metals. Not to mention nickel obviously goes into stainless steel. And we bought into this stock last month around the 60 to 62 area. We had 2 buy points. So we are going, our view on this is it's personally the cheapest valuation of any company I've seen in about 20 years. There was a small company called Colnet or Sprint Canada that was equally as cheap on a valuation basis in 2002, 2003, and I personally had a large position in that one. This is the cheapest I've ever seen a company. I think the amount is, you can see, or well, you can't see from this chart, but nickel has skyrocketed here and it looks to be sustainable. And this is a company that is not institutionally held. It's all kind of held by retail traders, retail holders or investors. They do not do fundamental research on this. I don't think they have a grasp on the power of the cash flows that's going to be spit out of this company. But again, similar to the E&Ps, but I think in much shorter term, I think within 2 years, this company could be taken private. So it would have its valuation is just incredibly cheap. Our view is we're really not going to do anything on it. We're going to hold it, sit on it, and I think it's a $5 to $10 stock, and it's, as you can see, trading around 75 cents right now. That's it.
All right, thanks, Paul. And again, in a passive portfolio, you wouldn't have these opportunities, and Paul's done great work to expose our clients to some of these opportunities, and I think it's definitely telling in our portfolio valuations at this juncture.
Yeah, Scott, I would just add as well on that with the tactical, just a caveat to clients. Those clients who have a bigger exposure weight to the tactical model in their overall weighting will find their performance year to date to be higher than those who don't have as big a weight or have a higher weight into fixed income, simply because of those 2 stocks that we just had up, Baytex and Sherrod, and a couple others as well that we've owned, both on the fixed income high yield side and on the equity side. So just a caveat to those clients that are listening and looking at their portfolios.
And that brings up a point too. And clients, we encourage you to have these conversations with us when you want to talk about risk, talk about your strategy. If you think your strategy needs to be updated or how that strategy is progressing and want to have a conversation around that. Of course, it's very much tailored to you, so we have to have those conversations with you at some point in time. We would like to continue to have those conversations, so please feel free, make sure you get in touch with us to do so. Paul, bonds, as we mentioned earlier, prices have been falling, yields rising as we anticipate both an increase in central bank interest rates and on the back of the inflation data. And often the strategy comes down to, the fixed income strategy comes down to where we position ourselves on what we call the yield curve. You may have a comment or two there.
Yeah, you know, quite frankly, it's been what they call a bear market steepener, or flattener actually, up until a day or two ago. But the whole section of the government bond yield curve has been hurt, i.e., rates higher, prices lower. We still have a bias towards being long bonds out in the slightly in the mid to longer part of the curve. But just looking at this pie chart, Scott, quite frankly, everything, the blue government bonds, the orange investment grade bonds, and the gray, the high yield bonds, detracted from performance over the course of the month. High yield slightly less than investment grade and government bonds, but they all detracted from performance. The yellow slice of the pie, preferred shares, the ones we own, actually improved and helped to add to some performance, or certainly reduce the decline from the other three segments. They are inversely correlated to government bonds. So as government bonds yield rose, these actually did a little bit better.
Excellent, excellent. That's a great update. Thank you. Okay, well, as I mentioned, portfolio reviews are paramount and important. We do try to get our clients to have one at least twice a year. Sometimes that's a little more difficult, but and I know Diane sends out reminders, and we want to remind you again verbally that we do need to have these, even just to make the regulators happy. We have to update documentation. So when Diane does get in touch with you, it is important that that you get back to us and set up a meeting or a review. And it is tax time, Diane. How are things going from that perspective for you?
Okay, at this point, thank you, Scott. At this point, the tax information has all been loaded to the Raymond James website, and I'm now going in and preparing the packages to send out to the clients. Once the packages are received, you can compare them with what you have or have not received, and you'll know exactly where you stand. And if you have any questions, please feel free to reach out. That's where that is at the moment.
Excellent. And I know that Diane has been working and burning the candle at both ends because there's we came out of kind of our RSP season and into tax time, and I know that she's been working diligently to try and answer everybody's questions, and it is we thank Diane for all of her hard work on this. But if you need to talk to us, of course, we're available. We want to have conversations about your portfolios, about anything you need to talk to us about. Please don't hesitate to get in touch with us. And again, thank you for taking the time to listen today. And on behalf of Paul and Diane, we wish you a great month of April and look forward to being back again at the beginning of May.